Dear investor, Edelweiss Private Wealth Management is pleased to present to you the latest issue of Investment Strategy Report for April 2018. Let's take a look at key highlights of March. Political risk returned to the fore as Telugu Desam Party quit the ruling coalition. And BJP suffered surprise defeats in the by-elections in the key states of Uttar Pradesh and Bihar. The index of industrial production grew 7.50% year-on-year in January 2018. Third consecutive 7% plus print led by sustained revival in commodity exports, robust trend in retail financing and favorable base effect. The Federal Reserve raised the target range for the federal funds rate by a quarter percentage point to 1.50 to 1.75%. Expressing confidence in the US economic recovery, it further signaled that the FOMC will raise interest rates 2 more times in 2018. The US president announced tariffs on Chinese imports worth $60 billion in order to check the huge trade deficit with China. China also retaliated by imposing tariffs on 128 US products with import value of $3 billion, leading to frenzy in global markets due to trade war fears. Equity view. Nifty continued to correct this month with the benchmark sliding by close to 5% during the month before posting a mild recovery towards the end of the month. The benchmark indices have fallen over 9% from the peak in the last 2 months due to a blend of global and local factors. Globally, yield curve flattening in US, liquidity drying up due to unwinding of balance sheet and rising interest rates making equity risk premium less attractive, and trade war fears are the key factors leading to correction. Domestically, aggressive earnings growth assumptions, imposition of LTCG, political events and mixed macros are hurting the markets. We are revising our Nifty target price for financial year 19 to 11,500 from 12,000 earlier. We continue to remain bullish on consumption, capital goods, building materials and road construction sector. EPS estimates for Nifty index for financial year 18, financial year 19 and financial year 20 are Rs 493, Rs 602 and Rs 707 respectively. As per blended estimates, index is currently trading at PE of approximately 16.8 times 1 year forward. We recommend investors to deploy 33% of fresh equity allocation while the remaining can get invested over a 3 to 4 month period in a staggered manner. Clients having high exposure to mid and small cap via direct equities may look at trimming their positions and moving to large caps or managed solutions. Fixed income view. The 10-year benchmark GSEC is hovering in the range of 7.30% to 7.80% on a semi-annualized basis. The markets have seen a lot of volatility in the last few days on account of a host of domestic and international factors. The government announced its borrowing calendar for financial year 19, wherein only 47% of its total borrowing will be done in the first half of financial year 19. This is a deviation from historical convention of around 60 to 65% of the borrowing in the first half of financial year. Besides, the government plans to issue more of short tenure bonds in line with the recommendations from various primary dealers to attract investors and reduce buyback amount by Rs 25,000 crores. This news led to a 30 basis points rally in bond markets. A sharper than anticipated moderation in food inflation, mainly vegetable prices, pulled CPI inflation to a 4-month low of 4.4%, even though core inflation remains sticky at 5.1%. We expect benchmark yields to trade in the range of 7.40% to 7.80%. Yield movement hereon will depend on inflation trajectory, crude oil price, auction demand-supply dynamics, and US bond yield movement. We do not expect a rate hike in the near term as inflation is expected to remain within the target band. We recommend investors to allocate 100% of their fresh fixed income allocation to long-dated buy and hold strategies and active accrual strategies with low to medium duration.